Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. Welcome back to our Finance Fridays episode. And on this episode, we're going to dive right in, start talking about the Bank of Canada's potential rate decision on September 6th with the current CPI data that was released for the month of July, as many Canadians were eagerly anticipating the latest inflation data for July released by Stats Canada earlier this week on Tuesday. The news had created some significant buzz in the financial and the markets, obviously including the bond market, where we saw those prices surge onwards and upwards over 4%. But after a 2.8% inflation rate just last month, some major banks were expecting that rebound in the consumer price index, or that uptick for July. And when the numbers were unveiled on that Tuesday morning at 8:30, well, they confirmed the expectations many had. July's inflation came in higher at that 3.3% mark that we saw plastered all over the news this week. Now, this unexpected surge in inflation led to discussions about the possibility of the Bank of Canada raising interest rates in September. Remember, the Bank of Canada is very dependent on these data points. Now, obviously, what are the implications of inflation and these data points for the Bank of Canada? And what is the Bank of Canada's potential stance going to look like as they review this data? So, why is this important? As our viewers are aware, the impact of higher than anticipated inflation data could push the Bank of Canada to take a stronger stance in combating inflation on September 6th. This situation arises as the CPI data remains persistently high, which has been highlighted several times, including by the Bank of Canada and Governor Tiff Macklem, the Governing Council. One thing they've been talking about is that sticky inflation. The inflation data showed that Canada's inflation rate surged to 3.3% in July. Much of that increase can be attributed to what they call base effects, and we'll unpack that in just a moment. However, there's a twist. Amidst all this negative headline inflation, there are some positive notes. Food prices increased at the slowest pace, which is an improvement compared to the previously observed surges that we saw happening over the last little while. And even though food prices are still expensive, we're heading in the right direction. Now, factors that are driving the CPI surge for the Bank of Canada and what their potential response could be. I mean, what are they looking at, right? What are the factors? Now, obviously, the largest contributor to CPI headline inflation was mortgage interest cost. That index showed a significant increase to 30.6%. This factor played a major role in headline inflation and remained the major driving force. If we look at the all items index, which is excluding mortgage interest cost, that rose to 2.4% in July. Overall, as we mentioned, the CPI surge was mainly due to obviously higher mortgage costs, but to base year effects when you look at things like gasoline. So understanding what base year effects are, we've talked about on the channel. So with that being said, let's take a look at the Bank of Canada's potential direction and communication strategies. So how is the Bank of Canada going to perceive this? And what are economists saying? What is happening in the marketplace? Now, I want to turn to Chief Economist Benjamin Tal, who's offered a different view on the Bank of Canada's potential response.
Yes, because quite frankly, this bank is not neutral. It's biased, and rightly so. We have to realize one thing. You give the Bank of Canada two options. One is a recession. The other is inflation, and inflation expectations rising. They will take a recession any day, because they know that if they overshoot, they can fix it by cutting interest rates. If they undershoot, then inflation expectations go up. You don't know what to do with it. So clearly they are biased, and they say, you know what, if we are going to make a mistake, let's overshoot as opposed to undershoot.
Love him or hate him, he is well respected in the industry. He does have some insight. Just last week, he suggested that the bank may have exceeded its rate hiking target. It is questionable, but during the interview with BNN Bloomberg, Tal sheds light on what he thinks the Bank of Canada's potential direction could be. He argues that the Bank of Canada is favoring a recession so they can increase rates, obviously see exactly what happens and pull back. That's his thesis. He's saying the Bank of Canada will increase rates, and if they overshoot, they can always pull back. But if they don't do enough, well, they don't know really how to deal with it. And obviously that could be more problematic for the Bank of Canada. So by looking at some of these numbers, what Benjamin Tal sort of explaining as well, and what the Bank of Canada has conveyed to us, our viewers, as well as to many Canadians, by stating that inflation will remain high until 2025, the Bank of Canada can effectively manage expectations without potentially implementing actual rate hikes.
And I think that if you look at the overall situation, they are basically buying time. Why do you think they're telling us now that inflation will reach 2% only in 2025? By doing so, you're actually not losing anything because you keep telling the market, listen, inflation will go down. Therefore, you control inflation expectations. But at the same time, you're not required to respond to any hawkish economic news because you know that you have time. So the Bank of Canada, by elevating the GDP growth and by increasing the duration in which inflation will reach 2%, they are basically buying enough time to minimize the error. That's more or less where we are.
This approach aligns with the managing of inflationary expectations, as consumers might adjust their spending habits based on expectations and potentially verbiage by the Bank of Canada Governing Council of higher rates for longer. This can thus curb spending as they anticipate higher rates for borrowing and mortgages, for example. So that they may not have to raise rates, they could be raising rates, but they may use very aggressive language to influence Canadians to stop spending.
You saw what happened earlier in the year where it looked like they paused and then they did an about face and raised again. I think what they might do at this point is talk inflation down. So there's always the threat that they can raise rates a little bit higher, but look at some of the other economic data. GDP for June didn't come in exceptionally strong. In fact, came in weak. If you look at the labor market, it's starting to show signs of weakness. So what the Bank of Canada wants, I think, is starting to happen.
Because if they give us a target of 2025, they realize, or the Bank of Canada has a runway now to make sure that inflation gets the target at 2%. And obviously they know there's going to be ebbs and flows within this period, but if we keep interest rates high until we get that 2% mark, and even once we get there, well, what is the likelihood of them pulling back is a question, that the Bank of Canada needs to address ahead of their next rate announcement. So obviously, there are some other data points that I want to pay close attention to, especially as the Bank of Canada will be meeting next month. The impacts on the real estate market and core inflation numbers, right? So what is the Bank of Canada looking at? Real estate, other things, and core inflation. Remember, headline is important, but core is more important. So adding in that layer, fresh data from Canada's Real Estate Association, CREA, shows a mixed bag of signals. We saw a continued slowdown in the real estate market in July. Some highlights include slight decrease in national home sales and an increase in newly listed properties. The MLS Home Price Index also climbed slightly, and the national average sales increased year over year. So turning back how the Bank of Canada could look at this and how their approach may be relies obviously in addition to core inflation, right? Instead of headline, they're looking at core measures that exclude volatile elements like food and gas. These indicators had experienced a slight decrease, with CPI trim dropping from 3.7 to 3.6, CPI medium remaining steady. So they have obviously headline inflation ticking up because of these base year effects. As we see year over year numbers change, then we have obviously things like the real estate market, what's happening there. And obviously the Bank of Canada, knowing that they've tightened significantly and very closely monitoring that situation. This is what economists are basically looking at the current moment right now. So if we look at the arguments for what some economists are saying to maintain current interest rates, so obviously there's conversations about increasing, conversations about holding. Some analysts are advocating for the Bank of Canada to maintain its current rate stance as it stands now, highlighting several other factors that support their position, right? So remember, there's different sides. Half of them will say raise, some of them will say pause. While inflation has marginally surpassed the core range, right, that range of 1% to 3% at 3.3, we have experienced basically a reacceleration. The last time we saw was that in April. These indicators help price pressures in some regard. How do they help price pressures? Well, the bank's year-over-year tracking of those core inflation measures, specifically medium core rate and trim, have demonstrated a decrease, as we talked about, that from that 3.7 to 3.6, which for most economists, that is in line with the Bank of Canada's projections. This is what they wanted to see. They wanted to make sure core numbers, medium, trim, were coming down, and we're starting to get that. And there are other things that the Bank of Canada will be considering as well. And I just want to take a moment and go through some of those. So taking various factors into account, obviously what the Bank of Canada is considering, as I mentioned, the real estate, rising wages. We've seen those raises tick back up to around 4 to 5. I think it's at 5% now. Energy costs obviously are different from province to province. Robust, U.S. retail sales have picked up, so the consumer spending in the U.S. is up. It's plausible, that July's inflation acceleration was anticipated, mostly through those base year effects. When combined with other economic indicators, we saw around 45,000 construction jobs being taken away. We also saw those unemployment numbers tick up to the employment rates tick up to 5.5%. There are so many different influencing factors for the Bank of Canada on whether or not it's going to decide to hit the pause button or it's going to continue to raise rates. So and not to mention one important part, and something I think is underlooked by many, is what's happening with China. So China, unintentionally, or intentionally had to cut their policy rates in China. There's also a major concern around their debt servicing and obviously around their economy right now. Now, China is the second largest economy in the world, so it is a very important perspective for the Bank of Canada and what they could be doing come September, as they do have global pressure, right? So the Bank of Canada is looking here in Canada as a domestic concerns, what's happening locally, but most importantly, what's happening in the U.S., what's happening in overseas with China. So obviously, these are some things, but mostly, obviously, 50-50. Where are we going to be headed? I want to know your thoughts on what do you think is going to happen in September. Do we have enough data to say that the Bank of Canada can hold, or do we look at those numbers and say, no, the Bank of Canada is actually going to have to raise rates come September? Let us know in the comment sections below, but make sure you are subscribed to the channel so you will get our updates on the Bank of Canada's rate announcement come September 6th. Don't forget to hit the notification bell and leave those comments in the comment section below. Once again, thank you for watching. Remember, subscribe to the channel. It's free, and we'll see you next week. Thanks for clicking. Thanks for watching. We'll see you next week.